Should be up on YouTube. Should be up on the virtual trading floor. If someone can post the link here, it's on the Derrick the Trader YouTube. And again, people tell me generally that the video quality is better through YouTube than it is through the virtual trading floor. Up to you where you want to watch it. We'll ask little questions come into the virtual trading floor as much as possible. I also saw a message from someone that my volume wasn't very loud on one of the YouTube videos recently. So if that's the case and someone can message about that also, just to let me know, I would appreciate it. But yeah, once I see someone post the link, I'll get started. Thank you, Mr. Will 27. Great number there. 27 is my lucky number. All right. Thanks, Jack. Okay, I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. We get the position disclosure up. Where are my charts? Sometimes I'm hard to hear. I will try to be loud as much as I can. Usually I'm pretty good at being loud. Oh man, what a day. I'm kind of beat. I don't know about you guys. I'm a little exhausted from today's trading session, from this whole week in general. The volatility is just nuts. The volatility is just completely crazy. We closed up 2.2% for the SPYs. Decision fatigue is real. 3.7% for the Qs. 3.2% for the Russell. Huge up day. Wilson, what movie is that from? Huge up day today. Whew. Not necessarily the easiest day either, to be totally honest. Billy Jack. Not necessarily the easiest day either, to be totally honest with you guys. It was really tricky in a number of ways. But at the end of the day here, we've got a really solid, bullish looking daily candle within the confines of what is overall a pretty weak market. But we do know, like I've been saying over and over again, some of the biggest up moves in the history of markets tend to occur in bearish markets. Volatility has increased. We've got negative gamma. We've known for a while that positioning sentiment were extremely bearish. The way that I was describing that a week or two, or maybe a week or so ago, to the team here in ProDesk, was almost like a coil. Like that, the way that sentiment and positioning becomes more and more bearish, it almost like it tightens that coil. And then when that can explode, for whatever reason, when that gets unwound, it's a huge potential up move. Billy Jack. I'm not familiar with it. I gotta check it out. It can create a huge potential up move. And that is really what we saw, yesterday and today. It's a huge potential up move. The question, though, is does this change anything dynamically on the big picture for our market? So, like I think I said yesterday, one of my favorite exercises is to view the market in terms of bullish, bearish, neutral. And you can do that on multiple time frames, but I like to do it, kind of big picture time frames for the market, to see if we have continuity across our indices, to see if we have continuity across time frames, because that can be very telling in terms of how you should be positioning yourself from a probability perspective. So, very short term here, we can see as of the close, bulls are clearly in control. But beyond that, are they in control? What are our key levels? We said that basically every 10 bucks in the SPYs right now is important. We talked about 410, 430 was a big resistance level, 440 is a really big resistance level, maybe not so much 450. Then after that, you kind of have 458. And the fact that we recaptured 430 on a solid closing basis is a great thing. I would say that it puts the bulls kind of short term into control. But does it bring us from bearish to neutral? I could really see this being interpreted both ways. I could definitely see someone saying, all right, we recaptured this 430. We broke above these pivot highs here, so it has us getting back to neutral. The original level I had been talking about, and maybe this still is intact, is to actually get the SPYs above 440 on a closing basis for us to get back to kind of neutral territory. So what I'm going to say is that, you know, kind of big picture, medium picture here, that we are bearish starting to lean towards neutral. I think that would be fair. So like, you know, if you could imagine almost like a scale, right? Like a scale where you've got bearish, neutral, bullish. We're like bordering into neutral while still probably technically being on the bearish side. And where we would get to fully neutral would be, I think, above 440. And then it's only, as of right now, SPYs above like 457 do I think that this market actually begins to get bullish again. So we are a ways away from any type of resumption of a bull market or bullishness to the market, I guess I should say, technically. But great first step for the bulls today, especially post-Fed, which I will spend some time talking about. I want to take a look at the other indices first, though, to see if they confirm. Qs here. So similar to SPY 430, I think is Q335. And it's really probably only above Q350 that we actually really get back into that full middle portion of the neutral zone. So we're kind of working our way up the ladder, still technically on the bearish side. I mean, look, you can see here, you could draw a downtrend line. You can do the same thing for the SPYs. You can draw this downtrend line. We are still in a pattern of lower highs and lower lows. We are still bearish in the market. But the fact that we were able to recapture 335, which was a key level, brings us still in the bearish zone, but closer to that neutral territory. And if we can get above 350 on a closing basis, that probably brings us back into the neutral territory. And then only above 370 at this point, unless this picture starts to change over time, which it easily could, do we get back to kind of what I would call bullishness. So we are still in our downtrend. But maybe we are knocking on this downtrend line here. Maybe if that's able to break, it could trigger the next degree of squeezing. And this is, again, what I was saying a couple of times today during the day, why the understanding of market dynamics are so important. You could easily be shorting too early because you don't have this understanding of why ranges are so big. So that goes back to giving Pat's morning note a big shout out, and I think it is really important for that to happen. SPY 470, SPY 460. Let me go back to SPYs. Yeah, really, I'm looking at these pivot highs here. So they're about 457. So yeah, 457, 460. That range is where we would kind of get back to bullishness, I think, for the SPYs. So I agree with you there, Dave. Finally, for the IWM, again, the IWM has been an interesting index to follow because it led the market down. IWM rolled over first. We had this huge false breakout back in the beginning of November here. This false breakout higher where we cleared some big resistance levels. And we spent a couple of weeks above that resistance just to come back down. And I remember back here when the IWM was first getting back below kind of these lows here, and then we had this gap down at the very end of November. This was a major warning signal for the overall market. It was at this time that we really started to see breadth deteriorate, which was another signal for the market. IWM let us down. IWM went to bear market territory first. And then all of a sudden, out of nowhere, kind of starting in early February, it started holding up better and actually showing relative strength, while tech and the Nasdaq and the S&P, to some degree the S&P, started playing catch up to the downside. But it's the relative strength that the Russell has shown overall, with the exception of honestly the last few days, It's relative strength that the Russell has shown overall that has, I think, the IWM already back into neutral territory by being above 200 bucks. It's very sloppy here, but $200 has been a kind of a key inflection level, and it's a nice round psychological number for the Russell. So whenever we're below it, I think we're bearish. When we're above it, we're neutral. And if the IWM could really start giving a close above 207, it would start potentially giving trend reversal for this index, which would put you back into bullish territory. So to recap, we've got the SPYs bearish, clearly downtrending. Got your lower highs and lower lows, which includes today, but maybe getting closer to neutral. Q's exact same thing, and IWM not really confirming in the same way. IWM actually already being back to neutral. And again, what does this mean and why do I like doing this exercise is because if we are in a bearish market, especially when all three indices confirm that and it's happening on multiple time frames, what's your general rule? Your general rule is that you're better off selling than buying. Whether that's short selling or long selling if you catch bounces or whatever it is, you're better off selling than buying. If we're in a fully bullish market, there's a very general rule from a probability perspective, you're going to be better off buying than selling. And if you're in that neutral environment, it's really where the action becomes two ways, and relative strength and relative weakness become particularly important because you can be catching good up moves on what's strong, you can be catching good down moves on what's weak. So it's a good exercise there, and today was today was a heck of a trading session to kind of give us at least this short-term bullish feel with a really strong close today. Let's recap the trading session on a smaller time frame. We started with a decent sized gap up this morning, and I can see the argument here of this being a breakaway gap as opposed to a common gap. Breakaway gaps tend to not get filled as opposed to common gaps which tend to get filled. And there are supply and demand dynamics, of course, behind the reasoning there. The reason why breakaway gaps tend to not get filled is because basically what a breakaway gap is when a breakout occurs via gap. So what a breakaway gap can cause is short squeezing, and it can cause new momentum longs to start entering the market or FOMO longs to start entering the market. As opposed to a common gap, that doesn't put the bears in trouble. That doesn't create a squeeze. And if there are any longs, those longs are inclined to book profit on that. So those common gaps, and we're just talking about upside gaps right now, it's the same thing but reverse logic on the downside. That's why common gaps tend to get filled from a supply-demand perspective as opposed to why breakaway gaps do not. So why I could see the argument that this is a breakaway gap is because 430 was our key level. And we opened up pretty much exactly at 430. We were trading above it. Though you could definitely make the argument, and as a matter of fact I was, that's not a very clear, clean 430, and that the resistance probably extends itself all the way up to 432.30. 432.30 is the high of the negative Maribozu candlestick where we broke down from, so that makes negating this bar strategically important for bulls, and it's also getting you above where the 21 EMA is, which is that, in this case, upper band of equilibrium because we've been in a bearish market, which is at 431. But again, 430 has been like kind of the strategic spot that we've been talking about. So I could see, looking at 430, and especially when you combine and understanding the fact that we're gapping up with 430 with broader positioning and sentiment, that this could easily create a short squeeze. And I think that is exactly what we saw off the open. The market was really strong despite it being a Fed day today, and Fed days usually have very wishy-washy type price action up until 2 o'clock when the volatility begins. We had a really strong morning trading session here where market gaps up so it's extended and then just has momentum straight to the upside, which causes the market to become even more extended before, depending on which index you're looking at, giving a price or time correction on this 5-minute chart. For SPYs, there's a little bit more price correction than time correction. For the IWM, it was a little bit more time correction than price correction. I spent a lot of time in the VTF talking about these concepts today. This is a perfect example of a time correction. Market gets very extended. How do I measure extension? I measure extension as where the market is trading versus the space between the 8 and 21 EMA. So you got your market all the way up here at $199.50 for the IWM, while the 8 EMA is barely at 197. So you're looking at a market for the IWM that's extended by $2.50 to the upside. It's a decent amount for a 5-minute chart. So what does it do? It spends 20 minutes going sideways. And I think I even commented like right here at 9:45, and someone was asking me a question about it, which sparked the conversation. I was like, it would be so bullish if this market time corrected right now instead of price corrected. Because we're in a bearish market, we kind of should pull back. Maybe an initial bull short squeeze higher that then just dies out once those shorts are weak-handed and get out of the way. And instead, this bid was able to hold up. The market was able to go sideways. And again, what is this? It's basically a bull flag. All a bull flag is a time correction of extension. It's a time correction of an upside move. And it is very typical that those consolidations will continue to the upside right as the 8 EMA is catching up to the base. Very typical. So if you're looking to execute this consolidation and you're watching it, here is still probably too early. You watch, and as this 8 EMA catches up, you go, okay, timing-wise, the advantage is finally coming to me. Because, maybe you could have easily looked at the SPYs right here and said, all right, they're time correcting. Let me buy. But look, 8 EMA didn't catch up yet. So bottom falls out a little bit, becomes a price correction, then you get your pivot point, you get continuation. So when you're looking to trade those flag type patterns, it is very typical that you want to be patient for 8 EMA catch up to occur to base, and that's when you get continuation. And that seems to be when we really got continuation of kind of the squeeze up. And then, what did I say yesterday and today? Usually off the open, you get your normal, on a Fed day, your normal price action, your normal price discovery that's kind of occurring, and then starting at 10:30 or so, you really want to go hands off, because the market usually then just starts chopping around. People don't want to make any decisions until 2 o'clock, or any decisions that they wanted to make were already made. So look at how this price action just dies off. This is very normal, very typical on a Fed day. This price action here is garbage. If you're trading the market or anything that looks like the market in between 10:30 and maybe when we broke down a little bit prior to 2 o'clock here, maybe there was a little bit of opportunity. I know Felipe was buying like Nvidia or something at this low and kind of caught it, and I think Rowan was calling out Alibaba trades when the market had this pullback. But for the most part, if you were trading anything between like 10:30 and 2, and especially 10:30 and this little breakdown, you're doing yourself a huge disservice. You're probably just churning away profits or digging yourself into a hole or something like that. You got to know when to sit on your hands. Midday price action on Fed, usually garbage. Today, also garbage midday. We got this little intraday breakdown, which was kind of interesting. We were noting key levels that we wanted to see hold. 199 in the SPYs intraday, 230 in 199 in the IWM intraday, 230 in the SPYs. And I was actually getting worried here that we were going to lose this 430 key level in the SPYs prior to the Fed meeting. A little bit worried, but not too worried, because I had no idea what was going to happen come Fed meeting, and that could totally change the picture again. But I remember commenting, as we got back to down to 430, we just traded from 430 up to like 430, 450, back down to 430. You end up closing at 430 today. Then what is this daily candle going to look like? It's going to look like an upside tail. And if we close just below 430 today, it's going to look like a shooting star candle, failed breakout of resistance. And what have we seen twice in recent weeks? 2 major failed breakouts of resistance that led to lower price action. One was on this day, and this day got me good, by the way. March 3rd, I got smoked on this day. This was like one of the worst days I've had all year. I got totally faked out. Bulls were short time frame in control. We got into up to 440. 440 was a key level to get the market back to neutral. that morning pre-market, we saw an Iranian headline came out about getting an Iran deal done that turned out to not be true, but that headline, that as it hit, ripped the whole market higher. I got stopped out of my SPY short, and then had longs on, and then the market just totally rolled over and smoked me. That was one failed breakout to the upside. This one here, where was it? Was it there? Yeah, I think it was pre-market that it was above. I think on March 11th was another day pre-market. We were gapping up above 430, which was that key level. And then news happened pre-market that day that brought us all the way back down. I didn't get caught in this one in the same way as I did on this one because it's primarily happened pre-market. But there were two failed breakouts here in the last couple of weeks that then led to substantially lower price action, which again is how markets work. You get a fail. Basically, the reason why the market's able to go down so hard and so fast off this failed breakout is because of exactly what happened to me. I am the sucker on this date here that represents honestly the average market participant that causes the market to break down. I got stopped out of my SPY short. I think I got heavier to the long side. Market was a false breakout. Next thing I know, having to sell on the way down because you're getting stopped out of your positions, or you're trying to put your shorts back on at lower prices, and that can really break the market down hard and fast, and that's exactly what happened. So coming back to today, this initial move higher here, we're above 430. They give this opening short squeeze. Now we're back to 430, and I'm thinking in my brain, like, oh my God, this is such a key day for the market. I got no idea what's going to happen with Fed. But as of right now, if we lose this 430 and close below it, we're going to have an upside shooting star, another failed breakout of resistance. Bears are in control. We're downtrending on every time frame. And if the last time we had a major failed breakout was back here, and that made us go from 441 to 414, 415 in a matter of 4 trading sessions, is it possible that I see the exact same thing? You know, what is this, a 25-point down move? Maybe I see the SPYs at 405 by the end of open house week. So that's what I'm thinking about, getting a little bit nervous about it. Then Fed comes out. And oh my God, this Fed move was insane. So let's try to recap this Fed move as much as we can. I mean, first of all, the volatility was sick. We right away identified this upside point as a key spot for bulls to kind of reclaim because we sold off from it. So we spoke about 431.32. This is a very normal thing. Whenever there is a news event, pay attention to where the news event started. Whether that's good news, bad news, whatever it is. But if a news event happens and the market rips higher, pay attention to that low from when that news came out. Because if the market's ever able to negate it, the market's telling you, we don't care about this news. And on top of that, everyone who just bought it because they thought it was important is now out of the money, and it can lead to a fast move to the downside. Here's pretty much the opposite. We see initially the market selling off on the Fed on high volume. So if, and honestly at a certain point here was a lower probability if, but if the market can ever reclaim the high from where we started, what does it mean? What does it mean, let's say starting on this bar right here at 315 when we on a closing basis recaptured this high? It means that all of this volume, all of this elevated volume that was done here over the course of an hour and 15 minutes, much of that is selling. How do I know how much of that is selling? Because look at the volume as the market's moving down. You have a lot of selling volume kind of coming into this market. Shorts are coming in, longs are getting out. Once we negate this, it's the same thing. Shorts are getting squeezed, longs either are chasing back in, or at a minimum, those longs are not selling on the way up anymore. And if the longs aren't selling on the way up anymore, what does that mean? There's even less liquidity for those shorts who are getting squeezed out to be able to get squeezed out. So the market can go up even more easily as a result. This is just how supply and demand works. This is how technical analysis actually works. This is the true root of technical analysis, not necessarily chart pattern memorization, but understanding what price action does to the participants who are already in the marketplace, and therefore what they are most likely going to have to do next. So it's no surprise to me at all that this break higher then led to a really strong move. But I'm happy to break this down to even smaller time frame. You know, so the thing that we spoke about the Fed today. Pay attention for surprises. right? Surprises are what creates big moves as a general rule. If expectations are fully met, a lot of times what we see is just a lot of volatility and you end up where you started. But we have two other key pieces of information to pay attention to. One is that we're in a bear market. So the technicals would mean that if everything else is held equal and that there's no new surprise here, that we could trade lower. The flip side to that, and this was really kind of my thought process more than anything else, is we also know that markets hate uncertainty as a rule. And this has been such a highly anticipated Fed meeting today that if we do just meet expectations, we at least got the uncertainty out of the way. And by getting the uncertainty out of the way, that could actually be bullish despite the big picture market technicals. And while it turned out to be very sloppy, at the end of the day, that is really what ended up happening. But the initial move here was lower. Then we created this higher low, got extended to the downside, right? Extension on the small time frame. Look where the market's trading. Look at the space between the 8 and 21 EMA. Market gives its bounce back. I actually wanted to short closer to 429. I didn't get quite as much of a bounce as I wanted to be able to implement my short as this market was kind of breaking down here a little bit, and that just shows you how weak the market was. I honestly was getting a little bit frustrated. Well, actually, first we tried that one long trade somewhere in here. I can't even see the spot anymore, where luckily I was able to execute well enough to be break even on it. But then when this bounce came in, it's like, all right, let's look for a lower high in the equilibrium zone to be able to short. So I wanted to see if we could get a pivot around 429, and the bounce was so shallow. We only bounced to 428.50. I wasn't able to short. And for me, I'm long, right? So, it's not if you're flat and you don't quite get the price that you want, you don't get to execute your short position because you didn't quite get the price you want from an execution perspective, or, you just kind of missed the trade, it's not that big of a deal. But for myself, I'm long. I'm watching my P&L move down 5 figures, and I'm going, oh my God, I need to be hedged here, because now once again, with where we're trading right now, we could have this disgusting false breakout to the upside here in the market. We could close with a shooting star to the downside. We could be at 405 by the end of the week, and I still got long positions on. I got no hedges on those positions. I'm like, oh my God, I can't believe I didn't get the execution on this short, but I also wasn't going to chase price. Then I was looking to see if I could get an inside 5 on this candle to be able to execute. Didn't get the inside 5 to be able to execute the short. Never got short at all. We got extended again into the gap fill. And then it was right in here where I was saying, guys, we're extended again. Let's see if the market bounces. And at the same time, big shout out to my man Diego Parma for calling out what the TLT was doing at that time. Because TLT was really important for us to be paying attention to, right? This is the fast-looking ETF that I like to pay attention to give me an idea of what interest rates are doing. So what do we know? Generally, and it's a little more nuanced to it than this, but as a really general rule, interest rates up, good for banks, bad for tech. Interest rates down, bad for banks, good for tech. And again, it's a little bit more nuanced than that because you got to think about what the yield curve is doing, but that's going to be your general rule. So what am I seeing here? Bonds and interest rates trade inverse to each other. So bonds are trading down, interest rates are moving up, bad for tech. So what's going on here, at 210? What's going on at 210? Nasdaq's getting smoked. Market's getting smoked. It's bad for these types of risk assets. But then leading the market, before the market bounced, we got this notable hammer-type candlestick on increased volume in extended territory for TLT. And then, from that point, we started to bounce up. I think Diego started calling out his long kind of on the way up here for the team, and I was like, oh, I really like that. Let's see what happens with the market. And then it was actually this candle right here was really interesting to me. This candle right here at 235. I know it's on very low volume, so there's no real volume confirmation on it. But okay, what does this candle mean here at lows? All it means is price correction back to the equilibrium zone. And so you get price correction back up to the equilibrium zone. This right here should be a pivot high that breaks the TLT back down. This right here should be a pivot high that breaks the TLT back down. And it didn't happen. We didn't break down. This candle here was very interesting because this should have been the beginning of us breaking back down, and we didn't. And it was very notable. And then finally another little hammer type thing in equilibrium that then breaks up. So it was right kind of when I was seeing this. What time is this? 2:35. What time did the market bottom? 2:35. 2:35. That was it. That was it. That was your signal. And that's when I'm communicating to you guys as a team. I'm like, you know, watch to see if we can get a bounce here for this market because of what the TLT just did. And, you know, technically here your SPYs just filled that gap, right? SPYs actually ticked where are we on the day? SPYs are up 2.5%. We went negative. We were up like 2%, went negative, and now we're up 2.5%. Market is nuts. This market's absolute bananas. But this here was like that really key signal here on the TLT. Again, TLT starting to rise, starting to show strength. That means pressure to the downside on interest rates. Pressure to the downside on interest rates, that's good for risk assets. That's good for tech. So what started as a bounce, we now needed to pay attention to the key levels where we broke down from. The last pivot high, and again, the absolute high of the news move, which I just referenced the importance of. So we'll be right away, first for the Nasdaq. SPYs and IWM struggled a little bit more, but we very quickly gave that strong bounce here to get back above this pivot. That in and of itself already starts to squeeze out some shorter term, tighter shorts. Then we got back basically to this high. But what I noted to the team at 255 was, all right, we're back to this high, but we're actually extended. We're actually extended the upside on the small time frame. So be a little bit careful. Like, this is a good thing if we're able to negate this candle, but just because we trade above it while we're extended here, you know, look, all right, SPY is at 431.50. Moving average is back down at 429.50. That's $2. I know it doesn't look like a lot on the chart because the ranges are so big right now, but that's actually $2 worth of upside extension here. It's like, all right, be careful. And I think this is when Tommy, I think it was, asked me a question about, which I actually interpreted backwards initially, about a bigger picture lower high for the market, but maybe you said it wrong or I interpreted it wrong or something, I don't remember. So I started being like, well, yeah, you know, we're extended here, but what I really want to see is if the market actually can make a higher low off of equilibrium right now. Because we're extended, we should pull back. You know, again, what does this shooting star candle mean? It just means a pullback to equilibrium. That's all it means. These are not reversal candles. They're retracement candles. And there's a very important difference between the two. And this gave us a retracement to equilibrium. We held. And then I communicated to you guys, I think you can go long versus the 3 p.m. low. Because now we're starting to consolidate here right in front of this key spot from where we started. And what I said was, maybe not the best probability of success. No problem, Tommy. Maybe not the best probability of success, but a fantastic potential risk reward on going long versus the 3 p.m. low here. Because if we clear up and we get above this, what does it mean? It means exactly what I was just talking about. It means that all of this volume, short selling, long selling, all of it is losing volume. And that can really shoot you to the upside, especially in a market environment that is marked by high volatility, low liquidity, negative gamma. We can really overshoot to the upside in this type of environment. And that was it. You know, that was it. So definitely not easy at all to navigate this post 2 p.m. price action. But broadly, you know, again, here at the end of the day, looking back at the price action, seeing how we closed at highs, for the most part, there were no surprises. There were actually a couple little surprises. The biggest surprise to me on the whole trading session was when Pat said that the market was pricing in a 75 basis points worth of hikes over the course of the next two Fed meetings. I would interpret that as more bearish than the market was expecting. and could actually resolve us down. You know, what happened to one 25 basis point hike over the course of the next 7 meetings or whatever the heck they've been talking about? So maybe my information on that's like a little bit off, but I was surprised to see that. But you know, maybe it's shown that the market overpriced in this event, which is kind of what I was thinking from the beginning. You know, let's just get this uncertainty the heck out of the way already, and it could potentially provide a relief rally for the market. And the other thing that made that thought process a little bit difficult was the fact that we had a relief rally into it. Where I was originally thinking Friday last week was that we would actually be weak through Wednesday, and then maybe we could get the relief rally starting on Wednesday. But it actually, the PPI number gave us a jump start on that yesterday. That PPI number showing improvement gave us good strength yesterday. That led to the gap up this morning. That led to the short squeeze, and that created even more uncertainty coming into the Fed meeting today on how we might react, and that I could be wrong on my interpretation of you know, kind of sell the rumor, buy the news type situation here for the market. But it ended up working out really well. I think we were able to navigate the market as a team really well today. I didn't have a lot of brilliant ideas in the morning meeting as far as individual stocks go. I said that, you know, there really wasn't much that I liked. It was really all about the market today. I kind of brought up a couple ideas that I wasn't in love with, and some worked okay, some didn't really work at all. You know, we talked about maybe SoFi long through yesterday's high because the inside and up in extended territory, but SoFi got downgraded, so that was not that easy. It turned out to be an okay trade. It talked about, you know, Labu long versus like the yesterday high area that kind of worked out, but was also, you know, difficult. XBI did end up being a little bit relatively strong compared to the Nasdaq today, which is what I wanted to see. But the XBI is a ways away from proving itself, as XBI needs to clear above this like $89 to $90 resistance level. It's not even testing that yet. Just snapping back to the 21 EMA. I talked a little bit about the Uranium Stocks because this quadruple U reported earnings, but I mentioned I didn't think that this earnings report looked very good, to be totally honest. You could have tried to go long some of these uranium names versus yesterday's low as a technical trade in a sector that's overall been relatively strong as a result of what we've seen in uranium. But that UUU earning, I really didn't love it. But it did potentially put like a CCJ and a URA on the radar as well. So not really too much based off our morning meeting, which is usually where my best ideas come from as far as individual stocks go for today's trading session. Today was just really kind of like a do or die session between the bulls and bears and the market big picture, and we needed to kind of digest the information and navigate the intraday price action of the indices and things that are correlated to the indices like Apple. You know, and the biggest thing, and I still stand by this, is that if you didn't put on a lot of new risk today and you didn't catch like the big up move today, it was not easy to be able to do that. The best way to make money today was by the work that you did the last 2 days. The last 2 days, we had trades. Those trades tended to work out really well. And then it really depends on how you game planned them. If you game planned them based on the class that we had at noon yesterday, if you took the ideas that we had from yesterday's morning meeting as an example and game planned them as we discussed in yesterday's class, you still have stock from yesterday's prices at today's close. And that is how you're making the most amount of money today. That's how I'm making the most amount of money today. I had a great day today, but it wasn't as much based off of my trading today. I made money, you know, off my trading today, but it was really, I got paid dividends off of the things that I did well the last 2 days, still having that stock, keeping that stock, catching the gap up, dealing with all the volatility, trading around it a little bit, trading around it intraday, but, you know, buying Apple at 150 yesterday and Apple's at, you know, 160 right now. That's a solid 2-day move. And that's really where you pay yourself. You know, you got to understand when the opportunity is really there and kind of go after it and maximize your reward. And you got to understand when things are a little bit more difficult and kind of take a half step back. And as much as there was definitely opportunity today based off the volatility, and I think we navigated it really well as a team, I would not describe today as an easy trading session. You know, some like this day right here, February 24th, that was an easy trading session. That was a really, really easy trading session. We were screaming with maximum conviction to buy everything off the open, and everything just flew up huge all day. That was an easy trading session. Today, look at this price action intraday. Completely nuts. You know, we did manage to hold some key levels at certain points, but then look at this. You know, how hard is it to keep any longs from early on in the day throughout this Fed meeting? So hard. So hard. But, you know, once again, you know, shout out to ProDesk as a team, because we've got, you know, just a really strong team here. And, you know, it's not me, you know, it's us. It's we all kind of come together. We share our information. We have our different backgrounds. We have our different expertise levels, and you know, we are able to put that information together. I don't know if I would have been as on point with seeing the market kind of bottom here if it wasn't for Diego, as an example, communicating his thought process on the TLT. And that's just one example of what we see here, like literally every day, of how the team is able to come together and provide information that benefits everybody. So, you know, big shout out to the team today. Good stuff. And that's all I got. So I'm happy to answer any questions. All right. Like usual, I'm going to scroll up into the VTF to about 10 after 4. And I will just answer questions in order of how I see they may have been posted. The first question I think I'm seeing here is from Robert. What a day. I was $50 away from my daily lockout, then refocused Apple long versus the pivot low, which you're commenting out at 3 p.m. Awesome. I was able to scoop up a little stock down here too. Then holding 157. Yep. This was, you know, again, very similar to the market, getting a little bit extended to the upside, breaking above the 2 p.m. high, but with extension, and then, you know, pulling back. And there's your 3 p.m. low, and kind of getting the upside continuation there as well. Sorry, I lost your comment here. Where did it go? There it is. Where I added size. Perfect. This is perfect. Where I added size and turned my day. Solid green day, great teamwork. Thanks for leading us through the day. I'm not drinking, but I'll take some beer today. Awesome stuff, Robert. Robert joined our team, I don't know how many months ago it's been now, but kind of starting, I know you don't mind me saying this, kind of starting knowing nothing and asking lots of questions. You know, you really kind of joined us as a team here, like totally at the entry level, but asking. Every day, Robert would have at least one question for me in the afternoon meeting. And by putting yourself out there, by consistently asking those questions, your progress, based on what I've seen, has been tremendous over the months, or maybe we're working towards a year now. I'm not exactly sure that you've been part of the team. So Robert here is a great example of anyone who might be a newer, more entry-level person to not be afraid to kind of just stick your neck out and ask questions. Don't be afraid if it's a beginner question. We don't care. That is how we all make progress as a team. So awesome stuff, Robert. Great turnaround today. Yeah, I'm going to have to check this Billy Jack out, Wilson. Diego saying, last time I saw this kind of price action, trading Zimbabwe in 2006. You know, trading Zimbabwe. Do we have confirmation that Charlie Munger was buying more Alibaba today? I wouldn't be surprised at all. Me and Charlie have been in line on the Alibaba buying situation here. We'll see, I guess. From March, there's the lower lows again. So that is one of the most used tells in technical trends. But how many days of lower lows, lower highs do you want to see? 2, 3, 4, etc. Because also in those days there could be a break in that, but then we see it continue down even after that break. Marsh, I would suggest that you check out my candlestick analysis class if you ever get your hand on it, because that's where I kind of go through an example of trends and how they work and how they officially reverse. Because what you're describing here is basically trending markets. Lower highs and lower lows is the definition of a downtrend. Higher highs and higher lows is technically the definition of an uptrend. So what do you need? You technically need a high, a low, and a higher high. Right at that point, you've got the beginnings of an uptrend. That's actually what you need. So I guess it's really going to be, I guess you need at least 3 pivots. You need at least 3 pivots to make a trend. You don't even actually technically need the 3rd pivot to have happened yet. You just need, like, if you get a high, and I'm talking about uptrends right now, it's the same thing for a downtrend, but the opposite. If you have a high, a higher low, really all you actually need is to break the original high. You don't even need the 3rd pivot down to have happened yet. Once you break that high, you're guaranteed to have the next higher high. So that's all you really need is really, let's just call it 3 pivot points to kind of make a trend. But people jump start actually a lot of times. You'll have the high, you'll have the low, and then the market will start to go up, and they think they're in an uptrend. You're not in an uptrend until you are guaranteed that new high. So right now technically, and again, the market. So let me take a half step back. The entire root of technical analysis is trend. That's what it is. And I think I said this on Monday. In technical analysis, you've got all these different chart patterns, wedges, triangles, flags, and pennants, and all, head and shoulders, and hanging men, and all this nutty sounding stuff, right? But in reality, there's only 2 types of patterns. Continuation patterns and reversal patterns. Continuation patterns continue a trend, reversal patterns reverse a trend. Everything is based off the concept of trend. So if you're a newer trader and you're just getting started, there are 3 definitions that if I was working with an entry-level trader and it is day 1 for this entry-level trader, I'm going to say, hey, I need you to memorize 3 definitions. And these 3 definitions are the starting basis of every aspect of my approach to trading. You need to know the definition of a trade. The definition of a trade is something with a technical out and a technical reason. I went over that in detail in yesterday's class. Check it out if you missed it. That's definition number 1. Definition number 2, trend. An uptrend's a pattern of higher highs and higher lows. Downtrend's a pattern of lower highs and lower lows. Definition number 3, momentum. The definition of momentum is the greater the price, the greater the demand. Those 3 definitions are the core of my entire trading process. Everything else that we talk about is layers upon layers upon layers of other information that's based off of those 3 definitions. So that is where you want to start. And yeah, you get trend breaks and things like that. But definitely you want to check out my kind of training program class on that to get more information. I just sold some stock in a position. I'm not sure if I'm allowed when I'm streaming on YouTube to say that, so I'm not going to give any more information, but I just got filled on something on the offer. Market here is continuing to trade pretty nutty after hours. We're up over $1. Next here is Edwin. Do you consider SPY a gap at 417.71? 417. This tail is annoying me. This is not a real tail. 417. What price did you say? 417.71. Maybe I can see it on a smaller time frame here. 417. You're talking about this gap here? This is a gap, yeah. This is a gap that did not get filled. That was yesterday. So yesterday we had that common gap higher in the market that didn't get filled in the SPYs, but it got filled in the Qs and the IWM. Basically, Qs basically filled it. IWM 100% filled it yesterday, and SPYs were acting relatively strong yesterday, so they didn't fill it. They just kind of got down to technical equilibrium and bounced, which this happens a lot. So usually this happens in the direction of trend. It's rare that this happens in the opposite direction of trend, which is actually what happened yesterday. But if you had an uptrending market and that so common gaps tend to get filled, right? In a vacuum, no other information. Common gaps tend to get filled. But now we need to add on other information. So let's say you have an uptrending market. Common gap down will have an even higher probability of being filled than it normally does because the market's uptrending. Common gap up will have an even lower probability of being filled than normal because it's in an uptrending market, right? So what happens a lot and again, this is a little bit rarer, but let's assume for a second, just for the sake of a thought exercise, let's assume for a second that the market had been trending higher into the close 2 days ago, and then we gapped up. This is very typical then, that you don't get the full gap fill. You just get a pullback to equilibrium where buyers begin to come in early and work our way up. But this counter trend, because we've been downtrending, is much more rare. I would attribute that to the supply and demand dynamics that you can find in Pat's note. And let me read the rest of your question, because I don't even know if that was your question. Close on 3/16. Is this the 16th? I don't even know what today's date is. Today's the 16th. But open on 3/15. Maybe you wrote the wrong date there. Maybe you meant close on 3/14. And 3/17. Yeah. I think this is the gap you're talking about. Yeah, and again, that's why it's important to understand market dynamics, and that's also why it's important to look at multiple exchanges, because the Qs and the IWM did fill that gap. SPYs are just showing relative strength when they didn't. I think I covered your question. Tommy on the shorts. We know there's a lot of shorts out there right now too. And we have options expiration. It's quad witching on Friday. Oh man, you guys are here for all the days, huh? Fed day today. Quad witching happens 4 times a year, and it's like one of my least favorite trading sessions of the year. We'll talk about it Thursday night, Friday morning. And if you read Pat's note, it actually implies that this options expiration, I've talked about this in the morning meeting, as opposed to every 2021 options expiration, could actually have the opposite effect, meaning higher than what we saw previously. We just sold more stock in a position. Okay. Scrolling down here through the VTF, looking for questions. Yeah, we can look at Oxy as a setup for tomorrow. Tighter inside day today. Momentum trades above today's high. Closer to 50 bucks would be some support that I have interest in. From Big Ops Little Cash, how do you deal with the mental side in the off hours? I love these types of questions. I have only been in same day scalps and hyper scalps for over a year. How do you not sit there and watch the futures all night? That not having control in the off hours is nuts. Acceptance. I'd be lying to you if I said I never lost sleep ever in my life, ever in my trading career, about my overnight positions. And there was a period of time some years ago where it definitely affected me more than it does now. It's really about acceptance. There's nothing I can do. And if there's nothing I can do, what's the point about watching and fretting over the futures? So I've been doing it a little bit more recently again, but I actually kind of, as a more general rule, I try to not look at futures at night. But the market's been so crazy recently that I have been. Because there's nothing I can do about it. So why am I going to start bothering myself? Like, the worst thing I could do to myself, because I can't do anything about it anyway, is if I got a bunch of longs on and I check the futures right as I'm going to bed, at 7:30 p.m. local time, 9:30 p.m. Eastern time every day. Check the futures and then see, oh my God, we're down 3%, and then not sleep. It's one of the worst things I could do. So I try just not look, because I can't do anything about it anyway. So I've kind of learned that like a long time ago. The Josh here on the team has this fantastic habit of, whenever the market futures are getting destroyed, of texting this group, text them in with a couple other traders who've been on the team for a long time, like literally as I'm going to bed, just say, oh my God, the futures are going to zero, oh my God, this is insane. And I'm like, oh, thanks Josh, here we go. Now I gotta check where the futures are. and potentially struggle with my sleep a little bit. But you know, again, it's really just kind of acceptance. It just kind of is what it is. I can't do anything that I can't do anything about what I can't do anything about. So why, I'll deal with it in the morning. I mean, the very first thing I do when I wake up in the morning is see where the market is. That's for sure. But I just try not to look at night. I try to do other stuff, man. I try to go hang out with my former neighbor, and I told him to give me a call, even though it's dumping snow out, if he needs me to help birth one of his calves today. So that's it. Did you guys lose sound? Am I seeing that properly? Or am I talking to nobody right now? No. Sorry, I just saw your text number. Okay, got it. I don't know what I'm volunteering for. I've never seen a cow give birth. I'd be happy to help do that. Maybe not twice, but I'd be happy to do that once. I feel like if you're gonna eat them, then you gotta really be able to participate in the life cycle a little bit. I actually also we had a great conversation on Monday night. I was over there for like 4 hours about his process for taking off the bull's testicles, and I offered to help with that too. He stuffs them in this cute little trap, and then he either does it with a rubber band or cuts them off. Asked about eating them after, and he said it's been done. All right, TMI, right? Let me go through the VTF here and see if there's any additional questions. Robert, it's been 1 year exactly. Awesome. From Tommy, so you just need 2 higher low pivots on the third pivot. If it's a hammer doji, would be our trigger entry. Really weird that all you guys lost sound all at once. That happened on the YouTube too, or only in here? Anyway, I guess it doesn't matter now if you guys are back. So you need 2 higher lows. So basically, like one example of a bottoming process, and again, I really get into this with visuals on one of my classes, is say you got lower highs and lower lows. That's already been ongoing, and then eventually get a low, but then you get a high. Well, that could just be the next lower high, right? Yeah. But then you get a higher low. So now what do you have? You've got 1 higher low, but you still have lower highs. That's not an uptrend. That is 1 higher low. Now what you need is that last high to break. So it's really 3 pivots. Low, high, low, and then the new high actually coming in. So I guess we could actually say 3 to 4 pivots, depending on your perspective. I hope I explained that right the first time. It's a little tough sometimes just to do it, visually without examples. But again, you can check on my class on that for more details. Scrolling through here. I don't know what a pro gap is, Big Ops Little Cash. I think that comes from Sammy Abusad, and maybe the pristine method, because I know Sammy's a pristine method guy. and I think we use different terms for the same thing. But I've never, even though someone asked me the other day if I follow the pristine method, I've never gone through the pristine method. My understanding though is that there is a lot of similarities between my approach and what the pristine method approach is. So I definitely support people learning it, even though I don't know it. And like I said, learn from as many resources as possible. Another term that I do know of for a common gap is called an area gap. I don't really call it an area gap, but I know for sure that a common gap and an area gap are the same thing. But pro gap, I know, again, I'm pretty sure that Sammy uses that term. I think it might come from pristine, but I've never gone through that program to be able to answer that question. So I don't know. It could be the exact same thing, just a different terminology from where he learned from and from where I learned from. Gabriel hates quad witching. I'm with you. Not a fan of quad witching. Make sure the setups for shorts. Cool. D Flamenco, you crushing that Baba or what? That's what I think I'm reading right here. Felipe watches the futures all night. And that's probably why you're siesta during the day half the time when I'm trying to call you out on a question to see if you're still in the position. You went siesta. Dr. Pole? No, I never heard of it. Let me know about it. My thought on Oxy, I just quickly mentioned Oxy giving an inside day today. So if that inside day breaks up, you could have a momentum trade to the upside in what's been a very strong stock. If that breaks down, we could get a test of like the $50 area support to potentially buy a bigger dip on. Quant Edge, I don't know what Quant Edge is either. I've learned from so many different resources over the years. I really have, and I've put it together in the way that makes sense to me. And the resource that I've learned the most from is myself, to be totally honest. My own mistakes and my own successes, and just constantly studying them. But I've read book after book after book, blog after blog after blog article, listened to. Back in the day when Redler and Sperling and all those guys used to do that morning call and daily recap from the studio that we had in the office, I watched every single one religiously. I would pull information from everywhere I could get it. I had other people that I followed as well, and just learned from as many resources as I possibly could. Some original mentors I originally had at the company also. And put it together in the way that makes sense for my brain. Marsh. So for quad witching, I know there is more volatility, but it seems a lot of people also think it means everything goes down. It doesn't necessarily mean everything goes down, but read Pat's note from this morning. It did mean options X in general. We went down into it every month. Every month into options expiration in like all of 2021, we traded down into it. But that's because of option positioning at that time being very bullish, and that those bullish bets kind of getting unwound into options expiration. And options have just become an increasingly important dynamic of markets. Is that I think the options dollar value of options was greater than dollar value of equity trading, or some crazy statistic like that in 2021, I think, for the first time ever. It was something like that. I don't remember exactly. But it just shows the increasing importance of understanding market dynamics as they relate to options and what it potentially means. But what Pat's note this morning said was that this options expiration could actually be the opposite, because there's so many bearish bets out there from funds, so many puts that are out there that are going to get unwound, that could lead to a big bid. And then if you combine that with the other piece of information from Pat's note about money rotation into the end of the quarter from big funds like the Norwegian oil fund, whatever they call that, that have to rebalance into the end of the quarter, that could also lead to additional money flows to the long side, right as we are in a market that is, very, very low liquidity and high volatility. No, Natalie, we are not. We are still in a bearish market, but we've gotten a little bit closer to neutral after today. Awesome, Damien. Love to see it. Marsha's next question is one I really like. What are your thoughts on being a contrarian? It can be hard to keep following the trend when it appears oversold or at the top, for example. Some people like to enter after a few big down days. Do you trade at all like that? Yes and no. So, being a market contrarian sounds super sexy. Like, I am the guy who is smarter than everyone else, and I go on the other side of whatever the market is thinking. I come in on the other side. The reality of the situation is, the vast majority of the time, you're better off doing what everyone else is doing, right? So if everyone else is just buying and buying and buying and buying day after day, and the market's uptrending, the best thing you can do is just be going along for that ride. Trends can last for long periods of time. And on the opposite side too, where it pays to be a contrarian, and this is where it gets hard, is in periods of extremes. When everybody and their mother is talking about buying the stock market, the traditional one from Jesse Livermore is when the shoe shine boy starts giving you stock trading tips. That's when you know things have reached a point where you can start becoming a contrarian. We saw it. We just saw it at the end of 2020, the beginning of 2021. And look what happened. Look at the bubble that happened in the market that subsequently burst. Which, by the way, congratulations if you're in here today, even participating in this open house, because that means that you had the tenacity to work your way through that period of time, and that you love markets and that you still want to really learn how it's done properly. That's when it really pays to be a contrarian. And that's why, again, to give Pat's Note another shout out, that's why is Pat's Note so important, because he gets all the data in there about sentiment, but even more importantly, positioning. So when we start seeing the data that Pat is providing hit extreme territories, we want to start thinking about going the other way. And the second half of your question, when things appear oversold, coming in and buying the stock, or the opposite, that's a little bit different than just being a contrarian. That's just understanding extension rules and how market equilibrium works. Like, you can, and we do that. We do that all the time. For example, we caught this low, like perfectly at the open on this day, and this whole huge move. It doesn't necessarily make me a bull on the market. All I'm doing is I'm going, hey, SPYs are at $411. EDMA is at $435. We are extended to the downside by 25 bucks. That is massively extreme. Outside of this extension here, these two extensions here are a couple of the biggest extensions to the downside based on how I view technical equilibrium in the market that I've ever seen in my career. So we come in and we took advantage of that. It doesn't mean I'm bullish. It doesn't mean that we're not in a downtrend anymore. It just means that you look for a snapback. And that's exactly what we got. Snapback to where? Snapback to equilibrium. So that is a trade. That's where your red dog reversal, or the gang in the VTF here in the pro desk. Don't tell Scott. I'll tell Scott one day over some drinks. The gang here in the pro desk one day just decided, I call a red dog reversal, just decided to start calling it an Oldensmith overthrow. So if you see anybody mention an OO or a DOO, really what they mean is a red dog reversal. They just started calling it that. And it's a great classic trade. And basically what it takes advantage of is market extension. What's Scott talking about when he's talking about his red dog reversal? What is he really talking about? He's talking about a stock that's down 2, 3, 4 days, buying it back through the previous day's low for a snapback. What I low-key take issue with, don't tell Scott, I think it should be called a Red Dog Retracement. That would be a more appropriate name. But Red Dog Retracement doesn't sound nearly as cool as Red Dog Reversal. Because really what you're looking for is a retracement back higher. I'm sure Scott will tell you guys also, picking tops and picking absolute bottoms in the market is not his game. It's not my game. It's generally a great way to lose money. But we can have our red dog retracements come in by recognizing downside degrees of extension and that kind of snapback trade. What I like to do is I like to anticipate that trade's going to happen ahead of time, and then try to find smaller time frame entries before we trade back to the previous day's low, so I can get an even better risk reward. It's a great question there, Marsha. I really like that one. Whew. Yep, options are moving stocks for sure. From Arnie, can you tell me what the spikes and after hours SPY mean? Is a sign of direction? Are you just talking about those little ticks? So sometimes what you see is false prints after hours. They're all dark pool prints or something like that are getting settled, that kind of give you these weird tails. It especially happens on earnings. I don't see any in the SPYs right now. Or here was some at 8 a.m. It happens almost every day. Here was a couple pre-market. These aren't real. These are delayed dark pool prints hitting the tape late or something like that. But they can kind of give you a false chart sometimes really quick. So yeah, I think that's what you're referencing, Arnie. Many energy stocks had an inside day today from Jimmy. We'll take a look at that tomorrow morning when we're figuring out our game plan. Yes, Bill. Honestly, another example of understanding sentiment is in the movie The Big Short, when he starts, going to the strip club in that scene, and this is a true story, I'm pretty sure, and he starts learning about how they have multiple houses and stuff like that. Assuming PDT is met, how much money minimum do you need to do this right? How much percentage can one hope to generate? It's a hard answer. It's a hard question to answer. One of the benefits of being a professional proprietary trader is that PDT does not apply. So you, as a professional prop trader with T3, you can actually have an account as small as $5,000. We generally don't want accounts that small, to be totally honest with you. We generally do want bigger accounts than that. And for reference on the upside, we have professional accounts here where traders contribute 6-7 figures into them. But we will accept people with as low as $5,000, and then you don't have to worry about PDT, and you get a lot of capital access. The capital access you get as a professional trader is a double-edged sword. It can really juice returns, but it makes risk management significantly more important, because you can also lose a lot of money in a short period of time if you leverage yourself up 20x in a position and that position just is going against you. You don't have a game plan for risk management. Great way to lose a lot of money. But I do think, and I tell this to people because it is the truth, as a general rule, the more money you're working with, the easier this business is. It is a general rule that I do think is true. It allows you for more game planning flexibility. But the truth is, back in 2010, I started with $5,000 in my account. And, I, between yesterday and today, made more than my first full year salary after college, because I built into it over time. So it's all about scale. You just got to work the scale over time and build up appropriately based on what's for you. Yeah, so that's the best I can kind of do to answer that question, Lance. It's all about adding scale over time and consistency. There's not really too much of a difference between making $100 a day and making $1,000 a day. It's just about doing the same things with it's just about doing the same things with having the larger psychological capacity. It's about doing the same things with having the psychological capacity to handle the larger numbers. Gabriel, please. Yeah, on the SPY here, I don't really see any spikes after hours today. I know what you're talking about though, and they're usually not real. But I don't see any crazy dots here after hours right now. A red dog retracement, red dog reversal. It's basically any situation where you've got 2, 3, 4 down days in a row, and the stock trades back through the previous day's low. And the way he teaches it is that you want to buy that stock or that market back through the previous day's low with your stop loss as the low of the day. And that's technically how that trade would be done, and then you're looking for a retracement higher. There's other factors there that you gotta be thinking about though, mainly risk reward, because really what you should expect off of that is a retracement back to equilibrium, and there's a good probability, probably better than 50%, that you are going to get that retracement back to equilibrium, especially if there's volume confirmation. But you got to assess the risk reward. Like in my opinion, buying the SPY on this day here in January at 438 when it got back to the previous day's low with a stop loss of 421 because it's the low of the day is irresponsible risk. It's a terrible risk reward. It doesn't make sense. It's not always this bad. Sometimes it's great. Sometimes you can do it with really great risk reward. But that's what you got to be thinking about when you're taking the trade, is does the risk reward make sense? So it goes back to what I was saying of, I like to anticipate that red dog reversal is going to happen before it happens and look for execution on a smaller time frame, like a 5-minute or 15-minute chart ahead of time. Then if I get the red dog reversal on the daily chart, now I'm back into that situation that I keep talking to you guys about looking for intraday risk for daily chart reward. You can get intraday risk for daily chart reward, and you're going to have some phenomenal risk reward ratios. Hope that helps. Done. Lance, you can do it with $5,000. The $25,000 pattern day trader rule does not exist on a professional proprietary trading account. You don't have to worry about it. There's different rules for professional accounts than there are for retail accounts. So you can fund a professional account with as little. And again, I don't really recommend this number. It really is beneficial to try to be able to do more than the minimum. But the minimum is a great starting spot for learning and consistency and things like that. If that's all you can do, that's fine. But pattern day trader rule does not. It's not a thing in a professional account. So you can have a $5,000 risk capital contribution in a professional account, and you can buy and sell to your heart's delight. Arnie, I don't see it. I'm really sorry. I'd love to be able to answer your question. I just I don't see green or red spikes here at any time. Now I'm sharing the screen right now. You can look at the screen I'm sharing. I don't see this today. This all looks normal price action. These here, yeah, that's from 8 a.m. And it could be that my charting software is smart enough to recognize that they were fake sometimes and just take them out. But they're not real prints. They're delayed prints usually. They're like a dark pool. Dark pools, oh man, I could go into another tangent right now, but it's starting to get late and I'm getting tired a little bit. Dark pools, I've been a professional trader for a dozen years. The market is not fair. In some ways, the market is rigged. I am the first person to say that. It doesn't mean that you can't make money and be a consistently profitable trader. You just got to know the rules of the game. And there are certain advantages that are afforded to institutional folks or whatever it is that just shouldn't be allowed. Dark pools is one of them. Dark pools shouldn't be a thing. Everyone should have access to the same information to create a fair playground. The reason why dark pools were created was to stop day traders, honestly, people like us, from front-running institutional orders, which is some of the stuff that I used to do back 10 plus years ago that I was talking about actually earlier in the day today. So I think UBS was the first bank to create dark pools, and they went out to the hedge fund clients and they said, hey, stop trading into the normal light stock market and getting picked off by the day traders in your big orders. use our dark pool to route your order. We'll hide your information. We'll be able to execute you with other funds, and you'll get better execution as a result. And then, a handful of years later, UBS got hit with a massive lawsuit, probably not massive enough, probably wasn't even massive at all, actually, because they were selling the dark pool order flow out to HFT traders. Unbelievable how this industry is sometimes. Honestly, unbelievable. And I'll tell you what all these companies do. Banks, Facebook, all these tech companies. If you can commit a crime, but the fine of getting caught on the crime will be less than the amount of money that you're going to make from committing the crime, what are you going to do? That's the equation that all the banks work with. That's the equation that Facebook works with. It's totally unbelievable. It's totally unbelievable. But I can't do anything about any of it. So I just understand how it works and position myself to make money. So anyway, kind of best I can do then. Yep, for sure, Tom. All right, gang, it is 5:30. It looks like I got through the questions. Heck of a day today. I'm beat. Starting to lose my voice again. Enjoy your night. Relax a little bit. Don't watch the futures as you're going to bed. And I will see everybody tomorrow morning. And remember, if you're enjoying what you're learning, reach out to the wonderful folks here at T3 Live. Put O trading in the subject. And they got some special deals or something for you guys. Have a great night, everybody. See you tomorrow.